Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in studio here in Florence, y'all, for today's podcast. We got exciting stuff to talk about. Also, some huge news at 2:00 this afternoon regarding what the Fed is going to decide to do with interest rates. So the jam-packed show here today, but before we get going, it looks like we got to talk real quick about the Nuggets absolutely just land the smackdown.
Yes.
On pretty much the entire NBA. And I know that's like your jam. Like, I'm a big baseball, football junkie, and I'm not saying you don't like those sports. Obviously you do. But the NBA is kind of like your thing.
It is kind of my thing, yeah. And I appreciate you saying that because no one else in my life acknowledges that.
Yeah, well, I'm down with it. Obviously, you pay more attention to it than I do. So
I do.
I watched the game. I thought the Heat were going to take it to Game 6 and possibly Game 7 because they're going back to Miami, and they play pretty good at home. But didn't happen. Looked like Jimmy Butler ran out of gas and Heat lost.
Well, the whole team ran out of gas. I mean, if you go back to the Celtics series, I think what it is, the Heat lost 7 of their last 9 playoff games because they had a commanding lead against the Celtics and they got driven to Game 7. And they got gentlemen swept, which is the phrase now for a 4-1 defeat against the Nuggets. So they ran out of gas real early. I think they were kind of lucky to even get past the Celtics, honestly.
No doubt,
I mean, they were a better team if they had more conditioning and a deeper bench. They would have shut the Celtics down, way early.
100%, man. But
awesome for the Nuggets. I mean, in the last few years, we've gotten a Bucks and now a Nuggets. I mean, it's just great for the NBA, for the NBA fan, for the casual fan too, realizing that what parity there is in the sport and how many great players there are now. We're kind of out of the dominant superstar and out of the dominant dynasty era. Like, I have a feeling Nuggets are going to be more like the Spurs. Like, they might win 5 championships over like 10, 12 years. Doubt they're going to be like the Warriors or even, like LeBron James making the finals like 7 times in a row.
No, I'm with you, man. It was fun to watch. I love the playoff atmosphere for sure. I love to catch one of those games. And my Reds, I got to give a quick shout out to the local Cincinnati Reds. I know we did a podcast walking around the stadium last year. They were garbage. They were terrible last year. Lost 100 games. And I think right now they're about 2.5 games, 3 games out of first place.
Oh, that's awesome.
They're killing it. Bunch of young guys out there on the mound as well as the field. So if you haven't caught a game yet, I highly encourage you to go out to Great American Ballpark and go catch a game because it's a lot of fun to watch these guys play. I'm looking forward to the rest of the year, see what happens.
Yeah, this is one of the first few post-NBA seasons where I'm looking forward to shifting to baseball because my home team has been the Reds and my favorite since I've been little, and they've been not that great.
They've been really, really good. So I'm excited. Yeah, usually this time of year it's just like, all right, it's time to go to the pool, and I know I'm going to have to work, but I'm just looking forward and just like getting through the rest of the summer to football season. That's not the case this year, so I'm looking forward to watching the Redlegs battle for first place. So we'll see what happens, man. I'm excited. So that was sports.
We're moving on.
Now we're getting to the news. So for those that might be checking out the show here, welcome to the Financial Shepherd podcast. Very excited to have you here. Please don't forget to subscribe to the show. We're on YouTube pretty much every 2 weeks, doing it on the live YouTube live, so you can leave comments. You can also text them to us at 513-630-2664. And the reason why we do this show is mainly because I know all of those folks, both clients and just the public in general, is probably going to want to have a better financial situation. Like, every year I check the surveys from the public. Capital One does one religiously every year. And no surprise, 74% of Americans say the number one stress in their life is their personal finances. That really should not be the case. I mean, we're the biggest economy on the planet. We are the standard currency, if you will. So it just really shouldn't happen. And there's a lot of reasons, that's the case, that why people feel that way. But I think a big part of it is that individual human beings, that make up the investment market, watching all the news outlets. And the news does a really good job of placating into individual human emotions. We're all hardwired with this thing called fear and greed. And there's a study called behavioral finance. You can literally get a PhD in this from every major university on the planet these days. What that study basically tells us is that this is how people make decisions with their money under stressful circumstances.
Yeah.
And human beings, unfortunately, feel losses twice as much as they feel good about making money. And I'm telling you all this just because I know that the news producers understand the human emotion. And that's how they're able to keep people's attention on their programs. And that's their job. I'm not knocking the news. They're doing their job and selling advertisements. What they do a poor job of, and why we're here, is they do a very poor job of looking at what history has to say under similar circumstances, because it's never the first time we've been through something other than the pandemic. I'll give you that. We never shut down the global economy for 2 years.
Yeah. But
other than that, you can always look back at history and say, hey, this happened before. What happened back then? And likely what happened over the preceding 6, 9, 12 months. And that's what gives you control over two very crucial topics. One is temperament. Temperament's just a fancy way of saying this is how I can control my emotions under these stressful circumstances. And how we do that, how Warren Buffett does that, is he looks at what history has to say, because the one thing that Warren Buffett famously said is human beings do not learn from history. So if we can give you that education, now we can start to make better decisions. The second thing that we get control over when we have historical precedent is we also get control over our asset allocation, which is just a fancy way of saying this is how much of your money is invested in stocks, bonds, and cash. Really smart guy named Harry Markowitz back in the 1950s won an economic Nobel Prize for this concept, and still is what's taught in every business school around the world. So if we can get control over our temperament by looking at what history has to say, now we can control our allocation, which is where 94% of the variability of performance comes from. Now you have power and control over what can at times feel like a very uncontrollable environment, specifically on the short run, but over the long run, human beings are very predictable. We haven't changed in over 2,000 years. If the market's made up of human beings, that's also going to be very predictable over a very long period of time.
Yeah.
And that's really what we're here is to help out with on those specific things. Now, a lot of news. I'm going to give you guys a lot of numbers and statistics today. I'm going to talk a lot about, history.
Yeah.
What I just talked about here. So yesterday, Tuesday, right? We're on Wednesday, right?
I hope so, because you told me to be here Wednesday.
Tuesday, yesterday, 8:30 in the morning, we got the latest inflation print, right? CPI. And I can't wait to talk about something else besides interest rates and the Fed, but that's the topic of the news. So here we go. Yesterday, CPI comes out. It comes in line across the board. All right. So CPI month over month, it was expected at 0.4%, came in at 0.4. CPI year over year was expected to be 4%. It came in at 4%. Core CPI year over year, which is the measure typically the Fed's looking at.
Yeah.
Expectation was 5.3. We came in at 5.3. This morning, we got something on that, S?
I was going to say that's a little too convenient. No, I'm kidding.
I have I have some thoughts about this. So I'm just laying out what happened, and I'm about to give you the real good stuff here.
Yeah.
So this morning, I'm waking up, having coffee, checking out the news, and we get this PPI data point, and it's not as I don't think well known for the average investor out there. So what is PPI? That's the Producer Price Index. It's basically a blend of indices that measures the average change over time in selling prices by domestic producers of goods and services. So companies that have goods and services, this is a measure of that. So think companies buying and selling things to other companies, both here in the United States and elsewhere. So it's a good measure. It's a good leading indicator for CPI, all right? Because if it's getting less inflation from a wholesale standpoint, right, then it should trickle down to retail consumers, you and I. So PPI, it was expected the month over month change was supposed to be minus 0.1%. We got a more negative number, minus 0.3, which is great. Core PPI. Flat, no inflation whatsoever. Big zero, donut. PPI year over year was supposed to be 2.3%, came in at 1.1. So literally half, basically. The core PPI year over year was supposed to be 3.3. It came in at 2.8. So way cooler than expectations. So that's a leading indicator for what future inflation is very likely to look at. Now, I brought this little Barron's, so people don't get the news anymore. Believe it or not, there's this actual thing called, a paper.
Super throwback, bro.
Right. Big time throwback. So I'm an old school, very blue collar guy. So I still get this, this newspaper from Barron's every, I think, Monday.
Yeah, you got to have something to read on the John.
That's right. And Barron's, finally, on the front cover is why I brought this. The front cover here says the market has legs, and it has a big bull picture on it.
Oh, show that to the people.
Yeah, that's right. So we got all this.
Oh, look at that.
Right.
They hire graphic designers.
So the market has legs with a big picture of a bull on it. Now, we've been talking for, I don't know, 9 months, something like that, about how we've turned the corner.
Yes.
This is a new bull market.
Yes.
And now you finally start to get that in a major publication from Barron's. Finally. So what does that tell me? Well, I'm going to look at what Warren Buffett has to say about stuff like this. He wants to be greedy when others are fearful. We were greedy when others were fearful big time last year.
Yeah.
And that's what got us some significant outperformance, by the way, for our clients. And we'll talk about that here in a second. But we've been bullish for like 9+ months, calling, this is a new bull market rally. Now we finally start to see that in Barron's. However, during the last podcast, you can go to shepherdwm.com, take you right to all of our Spotify as well as the YouTube channel. We talked about how bearishly positioned both retail investors and institutional investors. Retail investors are starting to change their tune a little bit. Why? It's because they check out stuff like this. They might not get the actual paper like I do,
Yeah.
but there's a Barron's app as well that I have on my phone. So they probably caught some of that. So retail investors are slightly shifting. You're seeing more what we call breadth. What that simply means is instead of like 10 companies pulling the market forward, which is what all the bears were talking about for 5 months this year, is the only thing that's moving the market is these big tech stocks because of this artificial intelligence thing, which, by the way, that's not new to us. We've been talking about why this labor shortage is a huge opportunity for the tech sector.
Yeah.
Go to shepherdwm.com. You don't have to take my word for it. We talked about it for months.
If you're here, you're on our YouTube page. Go check out the archive.
Yeah, check it out. So retail investors slightly changing their tune. Institutional investors, definitely not. I got some cool data points I'm going to drop on you guys. But the market itself is up 13% year to date. Shepherd Wealth Management customers on average, and this is as of 2 days ago.
Yeah.
Market's up 13% for the year. Shepherd Wealth Management clients, and this is for the whole book, right? About 70 households, 175 accounts. So some people are performing better than this number that I'm about to drop. Some people maybe not as good, depending on their risk tolerance. But the average Shepherd Wealth Management client is up 18.24% net of fees.
That's so rad.
So outperforming the market by over 5% net of fees. Very excited about that halfway through the year. And why is that? Is because we looked at what history had to say about all of these things that everybody was concerned about. We got an inverted yield curve. We're going to go through a recession. Everybody was calling for a recession. It was the most predictable recession of all time coming into 2023.
Well, and your point was we were already in it.
We did it last year.
If employment weren't as steady as it was, that we were already in the recession when people were saying it's coming in the future, you were like, no, we're in it now.
That's right. And
I don't mean right now as if this podcast, this is last year.
2022.
Yeah, you were saying that it was last year.
That was the recession. Inflation's peaked. I'm going to give you 3 reasons why we're not only going to get a pause today, but we'll have a hold on the Fed funds rate, this higher for longer thing for the rest of the year. That's what we're going to wrap up this podcast with. But we're outperforming not because I'm the smartest guy in the room. I'm telling you, I am not the smartest guy in the room in almost any circumstance. But when it comes to topical things like finance, investing, the market, retirement planning, taxes, estate planning, this is what I'm put on this earth for.
Yeah.
Okay. And all this data, I'm getting this data from multiple different sources. I'm not like creating this data and I only have it here in Florence, Kentucky, right? That's not what we're doing here. It's not possible. Maybe it is for some people. I don't know. But all this stuff I'm giving you guys have access to it. You either don't have the time or maybe you do have the time and you have access to it and you're not sure what to do with the information. Again, that's why we're here.
I think most casual, like you said, most retail investors just look at headlines.
Exactly. And that's why we do this show.
And they don't actually do research.
As I'm telling you, this is what the headline is, but this is what history has to say about it. Now we can start to make some smart decisions, and that's how we were able to smack around the S&P 500 when there's still more bearish positioning for the quote-unquote smart money, the institutional dollars. The smart money is the pension fund managers managing trillions of dollars, mutual fund managers, hedge fund managers, the people that you see from the TV shows, billions, right?
Oh yeah.
Cool TV show. But those are the institutional investors to give you like a picture of what that looks like. That's to quote the smart money. There's still more cash sitting on the sidelines by institutional investors at a greater dollar amount than even during the 2008 great financial crisis, which for all those folks that don't remember that was the worst thing that's happened since breadline in this country in 1929. Like 2008 was that bad.
Yeah.
The only thing that you can compare it to was 1929. That's how bad it was.
It was worse than the pandemic.
Way worse. Not even, you can't even compare the two.
No.
But that's the outperformance that we were able to achieve. Again, not because we're trying to be these super analytical, smartest people. Let me show you this cool way that we've created to analyze the data that we invented right here in Florence. Like, no, man. Like, we're just using, I'm not reinventing the wheel.
No.
I'm using all the stuff that others have accomplished, like modern portfolio theory, asset allocation. And we already have had all this data for a long time. It was just harder to get because you literally had to get it from a newspaper, which was extremely backward looking and not timely at all. But now we have it everywhere. Like, I can get all this information that we're talking about from a phone, laptop, tablet, whatever. We're just looking at it and applying historical precedents, and that's how we're able to make really wise decisions for our customers. And plus, we surround them. Like, we charge 1% annually. Obviously, we're here to perform for our clients. I just gave you some pretty awesome performance numbers there. But for that 1% that we charge, if that household has $500,000 invested here with us, we're also putting them around our CPAs.
Yeah.
That prepare and file your taxes, answer direct tax questions. Right? You're transitioning to retirement, Social Security questions. When am I going to take Medicare? You know, how is that all going to fit into all this stuff? We're also going to prepare and file your taxes at no additional cost, or give you a credit if you want to use your own CPA of up to $600 to prepare and file taxes. And same thing on the estate planning side, right? $500,000 household. If you got estate planning needs where we need to look at updating a will or revamping a trust or creating a trust for an individual, family, or business, then we'll cover up to $2,000 worth of those costs on an annual basis. So we're not just here to be really good fiduciary investors. We're truly trying to give you all a different experience that holistically surrounds you with the types of people that can give you pertinent advice at a timely manner, all at one low price point, and the returns are pretty good so far. So obviously this is a year-to-date number.
Yeah.
So we got, I am 36 years old. I'm planning on being around for a while. So we're going to keep updating this. We're going to keep updating this on a regular basis and comparing ourselves, benchmarking ourselves against the S&P 500, which is, I think, a fair way to go about doing that. And we're very excited about what we've been able to accomplish. We went over all this stuff in a seminar. And I think last week's podcast, I kind of summarized everything in that seminar. So if you haven't checked, if you weren't able to be at the seminar, check that out, shepherdwm.com. Last week's podcast was awesome. And I forget the title already, but we could pull it up and make sure everybody knows all about it. So that was the market performance. Now, I wanted to get to the 3 reasons why I think that we're not only going to get a pause today, but we're probably going to have a pause or no more rate hikes for the remainder of this year.
Oh, excited
for this?
As long as it turns out to be true. Yeah, those hawkish bastards.
That's right. So I got some notes here. We'll talk about this and kick it around. So as I mentioned, CPI yesterday came in line with expectations. We saw a little bit of a rally in the markets yesterday. And to us, this is evidence of a drastic offsides positioning of investors. So as I mentioned, we got inline CPI data. And market had a little bit of a rally knowing that the Fed was going to talk, this afternoon today.
Yeah.
To me, that's really evident of the fact that investors, specifically the retail and institutional investors, like we talked about, they got too much cash and they keep seeing the market push up. And specifically on the institutional investor side, like think about this. Think about like if you were me and you were charged with managing, tens of millions of dollars for families and business owners, and you were using the playbook that everybody else said that you should use coming into this year, like recession's going to happen for sure. And we have to be significantly overweight and all the stuff that worked in 2022, like energy and staples and healthcare and stuff like that. You would be so wrong and so underperforming the market right? And if you're doing quarterly reviews like I do, you got to have that conversation of why you're underperforming the market and what you're going to do differently going forward. Now, if you're that institutional investor, you're 2 quarters into the year almost, right? 6 months into the year.
Yeah.
Last year was probably a bad year for everybody, right?
Yeah. Even if you were beating the market, you're still losing money.
Right. We beat the market last year on average for clients, right? But we were still down.
Yeah.
Right. So that wasn't fun. Everybody was probably off sides as far as underperforming the S&P 500 last year for most people, whether you're a professional or you're a do-it-yourselfer. But think about the professional that had a rough year last year and told all their clients, like, 2023 is going to be a recession, just like all the other headlines were saying was going to happen. Oh. And you kept the same positioning.
Oh.
Right? So you're underperforming the market in a bull market.
Yeah.
And you can't say it's not a bull market now because on the technical basis, like if you want to pull up the little, academic book, the definition of a new bull market is a 20+% rise from the lows. And we've already seen that. Yeah. We've already passed that on the NASDAQ, and we've now seen that on the S&P 500. So I don't want to hear that we're not in a bull market. Like I can literally list off about 15 things off the top of my head that makes it a bull market.
Well, yeah, if you're going to fearmonger in the headlines that a recession is inevitable, you got to do the flip coin and now realize we're in a bull market. 100%. Everybody's saying it.
Right. Now
it's on CNN. They don't know anything about finance.
This is my point. I'm going to give you 3 other reasons, but the institutional investors so offside, meaning they have all the cash on the sidelines and they missed out, and they might be able to show their customer, oh yeah, but you're going to get 5% in this, 6-month treasury that I put you in. Mm-hmm. But if you put that in recently, you literally have to hold that for the whole 6 months to receive that 5%. The market's up 13%, right? That's a bad opportunity cost if you're sitting on 5% and the market's up 13.
Yeah.
You're going to look like an idiot.
Yeah.
So this is my point. All the institutional investors, if they're doing these reviews on a regular basis with their customer, the customer's going to say, hey, what the hell? Why are we not participating? So they're going to be forced to participate here very, very soon. And that is going to be a big tailwind for why I think the market will continue to push higher. Huh. So I want to start with that. But I do think that yesterday's CPI report is positive news as it relates to this fight on inflation. So first, next month, we'll get another CPI print. That'll be the June CPI print. Now, CPI, as we've talked about, I don't know, for freaking year now, that is an equal weighted measure for inflation. So it takes the last 12 months of inflation and gives it an equal weighting. Well, next month, when we get next month's inflation report, we will be dropping last June. So 2022 June inflation will be dropping off the CPI.
Okay.
Does that make sense?
Yeah. Yeah.
Now, that reading, just for those that maybe might be playing, inflation trivia at home, inflation in June of 2022, month over month, was a 1.2% reading result. I just told you that the number we got yesterday for CPI was 0.4%. So that was 3 times the inflation in June of 2022 as what we just got. So that number's dropping off. And as a result, the June 2023 CPI report could fall. This is next month. This could fall to as low as 3% on a year-over-year measure. On a year-over-year CPI print, we were at 4% yesterday. That's a full 100 basis points. That's a full 1%. So headline inflation is really what matters the most to the White House.
Yeah.
And therefore the Fed. And because of that metric, just the way that they calculate CPI dropping off, now what it will likely look like, if that's right, if we show a 3% year over year inflation print and the Fed has a Fed funds rate, right? We're assuming today in a couple hours, they're not going to raise rates. So they're at 5.25%. So if the Fed's at 5.25% in interest rates and we get a 3% report on inflation, that's 2.25% difference. That's definitely restrictive by any measure. So do we really want to argue for another 1/4 point hike in July? I'm going to say no.
Yeah.
I'm going to say no. Now that's just point number 1.
Oh, wow.
All right, so I'm just going to, we're coming out.
Firing from the hip here. Let's do it.
Guns blazing today. Second reason. So I told you that the CPI report was 0.4, right? We just got that yesterday on a month over month basis. Now, how do we get positive 0.4?
Okay.
It came from 3 places. There's a laundry list of things that make up the CPI, but 3 things you can literally look at and say, that's how we got to 0.4. First one was shelter, right? I came in at positive 0.22%.
And shelter is just housing,
rent, stuff like that, which is, everybody understands that's the last thing that's going to show up in CPI data.
Yeah, because that lag affects like 18 months.
It's huge.
Yeah.
Right. Even the Fed acknowledges that. Right. They know that that's falling down. When you raise rates as much as they did and as fast as they did, mortgages go to 7% like they are right now. And, it's not really good for the housing sector, but that's by design. That'll eventually show up in the CPI data. The second thing that caused the positive 0.4% number for CPI was used cars. Used cars showed a positive inflation of 0.15% month over month. And the last one was car insurance at positive 0.06. So 2 of the 3 was related to cars. Does the Fed and does the general public so concerned that we're going to have this spike in inflation and it's mostly going to come from cars? I don't think so. I really don't think so. If somebody wants to argue with me on that, bring it on. I don't think that the price of a used car and the car insurance associated with it should scare the hell out of anybody from an inflation front. I just don't see it. Now, shelter, understand that that's a very, very lagged indicator.
Yeah.
And the Fed can see right through that. Now, as for shelter, again, we know that this figure is statistically lag. If you look at the X shelter component, that's the sticky CPI. If you take out shelter, now you're looking at CPI on a 3-month annualized at 2.5%. It's pretty dang close to that 2% target that they keep, pounding the table on. We're going to get inflation back down to 2%.
Yeah.
You take that sticky, housing component out of there, and you do a 3-month annualized look at inflation. Now you're at 2.5, which is pretty great. So we really don't think that digging into, the Fed heels on inflation is going to be much of a problem. And that does give us another second really strong reason for continued pause of interest rate hikes in July. And in our opinion, probably for the remainder of the year. Third reason, we can now look at the CPI data, and this is giving you the historical stuff. This is really good stuff here. Nobody's talking about this on CNBC. I haven't seen it one time in Barron's or any other place that I actually consume data from.
Yeah.
All right. So third reason, the CPI basket of inflation, 42% of it is in outright deflation. That's an increase from April. April was at 40% of that basket that they used to calculate inflation. 40% was in outright deflation in April. That's now at 42%. So why does that matter? It's decisively higher the long-term average trends, arguing to me that inflation is sustainably cooling. So again, the 10-year average for the CPI basket to be in deflation, 38%. So we're above that. The 50-year average, right? So this is the 50-year average of that CPI, list of things that they calculate inflation on, showing outright deflation. The 50-year average is 30% of that basket. We're at 42%. 42% of the things that make up the inflation calculation is in outright deflation, which is way above the 10-year average and even more above the 50-year average. So we got not only history on our side saying that the Fed is done, but we can literally look at the metrics that made a positive 0.4 and say 2 of the 3, you can throw that out. That's not going to be the big cause of sticky inflation, automobiles and the insurance associated with it. Come on, get out of here. And I'm feeling pretty good about what's going to happen here this afternoon. Now, to wrap up today's podcast, what are you going to hear today? You're probably going to hear, we're going to pause. We're going to pause because you can see inflation is continuously falling. We've had 10 interest rate hikes, more than any time in history. And that gives us the ability to say, hey, we've reached a restrictive level. What we've done is working. We'd like to see it maybe move faster. That's why we're going to leave our options open for future meetings, meaning that we might increase rates in the future. And he's probably going to say it in a more hawkish tone than that. He's probably going to be like, what usually happens leading up to this, and I bet it's true today, is we'll probably be, positive, modestly positive on the major averages going into that 2 o'clock or the 2:30 presentation for Powell. And his prepared remarks are going to be great. Then some reporter's going to ask him a question. Now you got to think on your feet a little bit.
Yeah, and he's going to immediately chug a Monster Energy drink and like.
Well, what I hate about it is the question's going to be so baited. It's going to be like, hey, thanks for taking our questions, Fed Chair Powell. If inflation continues to not moderate and it goes up, would you guys increase interest rates? He's going to be like, hell yeah, we'd increase interest rates under those circumstances. But the news is going to remove those circumstances and the leading question. And you're just going to say, oh, Fed's going to keep tightening.
They said that we're going to raise rates.
So what are we going to do? I'm anticipating all of this. We're going to rebalance the portfolio for customers. Like I said, we've been overweight tech. So I talked about this in the last podcast. Three are major sectors we like coming into the year in order: technology, industrials, and energy. A little bit of healthcare, specifically biotechs. So don't take my word for it. Go listen to prior podcasts or go talk to current customers of ours. So we're significantly overweight tech. We are overweight industrials. Industrials about 8-9% of the market. We're more like 12. And energy is about 5% of the market. We're more like 8. So what are we going to do? We're probably going to take some profits out of tech. And we're going to take those profits, we're going to apply them, if I'm right, and we're going to get no more increases in interest rates. That's a really good thing for the smaller companies in the S&P 500, the mid caps and the small caps. They're finally starting to produce some positive results. We got out of those, I want to say a month and a half ago, just because it was just dead weight in the portfolio and we were doing so good in tech. We just added more to tech. Now we're going to do the opposite. We want to basically do the opposite. Now everybody's going to get bullish. I'm going to remove some of the weighting that we have in tech. I'm going to still stay overweighted, by the way.
Yeah.
I'm going to take some weighting off. I'm going to apply more to small caps and mid caps. And we'll probably also, if there's any funds left over, since we're already overweight energy and industrials, I don't need to add any more to that. I'll put some in a 5% money market, picking up some interest for customers as well. And because we're in a money market instead of a treasury, if something happens and we get a sell-off, for whatever reason, I'm ready to pounce into more tech, right? If we get a 5-10% pullback because, like I said, some person in the audience asked the Fed chairman a leading question that's very baited and the news strips out all the stuff leading up to that question.
Oh, it's going to happen.
Then you see the market sell off, I'm going to be a buyer of that. I'm going to be a big buyer specifically from a tech standpoint.
Yeah.
No question about it. And if everything that we've looked at is correct, likely what you're going to hear from us sometime later this summer is, hey, we did really good in energy and industrials. Maybe we're going to take some of those profits off the table and we'll see what other opportunities make sense for us at that point in time, whether that's more tech, maybe it's some other sector of the market we don't have a lot of exposure to, like financials. That could be really, really good if we don't get any more interest rate hikes, obviously. Now that makes that sector of the market start to look pretty attractive and significantly undervalued right now relative to its historical average, not just from a price standpoint, but also from a earnings standpoint on the PE ratio. So we got a lot of options.
Yeah.
If people will actually sit down and look at things from a different lens, and that lens being what does history have to say about similar events, you can start to get pretty tactical with that asset allocation, kind of like what I'm laying out here for folks. And if this isn't something that you have the time for or the temperament for, the stomach for, give us a call. This is exactly why we're in business. We're here to help. My name is Joshua Casey Garland. I'm a certified financial planner. I'm a fiduciary. I don't get paid based on what you're invested in. I get paid to produce results and surround you with the types of professionals that'll help you get through any situation, whether it's taxes, investing, legal documents, whatever. We have the right people with the right solutions, and we'll get you through those issues. So don't forget to drop those questions, 513-630-2664. That's what we got here for the audience today. Ez, anything that we need to let people know about that's coming up, or any shout outs or things that are coming down the pipe?
I don't think so. Other than just maybe want to let the audience know that, we're usually on a pretty specific 2-week schedule. We bumped that up this week because both Joshua and myself will be on vacation next week. So you can look for the regular programming of our live stream to pick back up in the first week of July.
Yeah. So,
and that'll be a little that might be altered around the 4th, but it'll still be within that first week schedule. We'll be back on everything. So.
Yeah. And if you like the show, don't forget to share it. Don't forget to check out not just the website for all of our podcast stuff, but every newsletter that I do from now on. I think we started that late last year, the beginning of this year. All those newsletters that I send out I used to just send it to clients. Now we're putting that on the website too.
Yeah. For y'all to look at.
So you'll get all that data for free, at least for now. And every Friday, pretty consistently, I'll still do this even on vacation for sure, is every Friday I post a little blog. And that blog's usually like, a little summary of what happened in the market that week, why things happened the way that it did. Again, I try to give you some historical precedents of what I think about those events that happened and give my thoughts about, based on history, this is how we might, consider handling that for customers. So don't forget to check all that stuff out. This is a lot of fun for us. Love your feedback as well. If you do have questions and you post those or any comments, we'll do our very best to respond to those. And certainly look forward to doing this again, either like Ez said, right before the 4th or just after it. But I'm very looking forward to today's Super Bowl, that being the Fed meeting coming up here in just a couple hours. So I'm gonna hop off of here and watch all that with you guys. And the good news is all this is on camera, so we get to look back at it a couple hours later and say, oh, he was right, or, he's just freaking wrong. So
yeah, we'll either be taking shots because you lost all your customers or we'll be taking shots because we were right.
I think we'll be okay no matter what happens here. But I'm looking forward to it. Hope you guys enjoyed the show. We'll do this again in a few weeks. Have a great rest of your day.